Hello and welcome to the latest of our fund manager interviews, today with Johanna Kyrklund, who is the Group Chief Investment Officer at Schroders. My name is Darren Johnson. I'm Senior Investment Consultant at St James's Place, having joined the company in 2007. After 2.5 long years of interviewing fund managers by Zoom or Teams, in the comfort of our own kitchens or perhaps in separate offices, I'm delighted today to be joined by Johanna directly and in person. Johanna is the lead manager of the St James's Place Managed Growth Fund and has been for several years. She's here to talk about her fund, global markets, and the large number of questions that you have submitted in advance of this session taking place. The structure of today's event will be for a short introduction to the process, to the fund, and then we will take on as many questions and market themes as we possibly can in the time allotted. This session has been shaped around what you want discussed, so let's get this underway. Johanna, thanks for joining me today. Could you spend 5 minutes just talking about your fund, your investment philosophy, and how you managed to structure the fund together?
Sure. In terms of what the fund's trying to do, it's basically a core allocation, includes equities, includes bonds, but we take responsibility for all of the risks in the portfolio. So I think it's a great one-stop shop, which you can then supplement with your high conviction ideas if you wanted to. It can also just be the client's portfolio, but basically it's designed to be a complete solution. And what we aim to do in my team is we aim to adjust exposures over the investment cycle. So this is not day trading, it's on a sort of 6 to 18 month time horizon, take account of valuation and the economic environment. And this helps us deliver a smoother path of return. And I think this year has shown why that's important. If you have an investment that's too volatile, sometimes your clients might not be able to stay the course. As much as they say they can withstand volatility, when things get tough, often people try and disinvest at precisely the wrong moment. By having a smoother path of return, by having a portfolio where the market risks are taken into account, which has the ability to adapt to different market environments, hopefully we can help your clients stay the course, and stick with a long-term strategy. Yeah. So that's essentially what we're trying to do. That's
brilliant. Now, I do want to structure this session around what people have asked. I think if we all watch the news, we can guess the kind of things that are going to come up. So obviously the humanitarian situation in Ukraine is absolutely awful, but we do get asked about it from an economic perspective. So that's something that I think we're going to have to start by talking about. From an economic perspective, what do you think has been the impact of the Russian situation so far? And in particular on your funds going forward, has it changed your thinking along the way, or are we in a consistent place at the moment?
I think the key thing is whenever you have a political event, you need to think about what is the transmission mechanism to the real economy. And in this particular instance, there's a very obvious transmission mechanism via commodity prices. And we're seeing it right now. We've got energy crisis in Europe and also food price inflation as a direct consequence of what's been going on in Ukraine. Now, if we think about, we came into this year already with an inflation problem, already with the prospect of central banks having to raise rates to quell inflation. And so essentially, the crisis in Ukraine accentuated that inflation risk, that stagflation risk. And that's really been the main consequence. And I would say generally, because who knows what the future holds, whenever you look at political events, that's always what you need to think is there transmission mechanism to the real economy? In this case, there was. Yeah. Now, with regard to the portfolio, we'd moved underweight equities because we were concerned about rate increases. And so in that sense, we were already defensively positioned. Clearly, as I said, because Ukraine exacerbated the stagflationary risks, it contributed to the weakness in prices this year. And, another allocation we had in the first half was to energy stocks, really to cope with the commodity price inflation risks that we saw. So that's been the main impact on the portfolio. I think right now, we've actually removed our allocation to energy. We did that in the second quarter because we're now shifting from an environment where we're just focused on inflation to being more concerned about the growth consequences of tighter central bank policy. And that poses a challenge to areas like energy where, demand destruction is already a reality at these prices. I think the main challenge we face right now with the Ukraine war is really how do you price Europe? So Europe on many measures looks cheap, but obviously there's a very significant recession risk at this point, given what's happening to energy prices.
And cheap can sometimes be cheap for a reason.
Yes.
That's the key there. I think in a world with so much noise, 24-hour news, social media, etc. How tough is it to remain consistent of trying to cut through that and not be reactive? I think many clients do get carried away with some of these things? And how easy is it as a fund manager to cut through that noise?
Well, it is tough. I read all the papers. I like to read the full spectrum. So, I'm a human being as well. But I think that it's always thinking down to, if you can really boil it down to, whenever you read about an event in a paper, you need to think about, is it going to affect rates? So is it going to increase the likelihood that rates are going up? Because that is the fundamental discount rate that will affect the valuations of all the assets you own. Or is it going to have a real economic impact? What is the transmission mechanism, as I said? When you look at things through that lens, you can read a lot of upsetting news that makes you sad about the world, but ultimately doesn't have an impact on the discount rate or the growth environment. And that's how you really cut through. You sort of boil it down as much as one can cut through, essentially focusing on what's the interest rate consequence, what's the growth consequence, and therefore what's the valuation consequence. And that's how we cut through it. I think the other thing we need to remember as well is that markets move quite quickly to discount uncertainty, and that sometimes you mustn't lose sight of the fact that actually opportunities to actually generate return in the midst of volatility. So volatility often is the friend of the long-term investor, not the enemy.
Yeah, and that's important to recognise for anyone who's investing for the long term, is how long do you want your money to be invested for, and and what's your objective? I think if the objective is growth, then the probability of success is always longer, is always higher the longer you invest for. That sort of deals with where we've been and where we are. In terms of, one of the questions we got quite often was, is this as simple as if Ukraine gets solved, if that makes sense? Is it as simple as if Putin leaves Ukraine, then all this goes away? Because it doesn't feel like that. And we got a lot of questions around what's the potential catalyst here for an upturn. So we've had vaccines in 2020, or we've had QE in 2009. In 2022, what does a solution look like to this? Because, as you pointed out, inflation was there anyway.
So we also have to think about what can we sort of have a view on, right? So actually, it's not just the Ukraine that's going on. There's a rate problem in the States, so you have very tight labour market in the States. The nature of inflation in the US is much more pervasive. So regardless of anything that happens in Europe, there is a rate cycle going on in the United States, and for now the Fed is not for turning. They're still focused on raising rates. That's the story in the United States. Then we mustn't forget China. China's had its own particular challenges to do with COVID, rolling COVID lockdowns, which are ongoing, and again are sort of posing a bit of a challenge to growth in China. So those are two things that are happening anyway. So I think if Ukraine was resolved, first thing is we can't predict what Putin's next move is. So it's very hard to sort of have an edge in that. There is a point, I guess, where valuations get so cheap that you can buy regardless of what you think is happening in Ukraine, in Europe. I don't think we're there yet. I think that people haven't fully appreciated the recessionary consequences of higher energy prices. I think a catalyst, actually, regardless of who knows what Putin will do. That's to the limits of my knowledge. Is there potential for government intervention in the energy markets to basically cap prices for consumers and for industry? Absolutely. And if we saw evidence of that, that would be a catalyst for Europe to rally quite hard, I think. Even if the environment is bleak, it would be the news is getting less worse. In a sense, the government's providing a backstop. That's quite important to remember. So we'll be getting some information on that in the next few days. So watch that very carefully. So Putin, I don't know, but watch what the European policy response to these energy price increases. That's Europe. Let's say they step in, and actually it means that the impact on the European economy is not as extreme because energy prices are kept under control. The government provides a backstop. I think we still have a bit of a digestion problem in markets because rates are going up in the States. And actually, if to some extent some of the recessionary consequences of Ukraine are put to bed, the ECB also faces an inflation problem still. So that means rates are still going up. And I think that's the thing we need to be careful of, is that probably we're still a bit early in the rate cycle to say we've reached the bottom of the market. So that's the challenge, more medium term. But even there, big adjustments happened. I mean, again, when markets have fallen so much, people get depressed. News of the energy crisis. Good news is that valuations have improved significantly this year. Market has priced in quite a lot now. Yeah, that's a question we get quite a lot as well. Is everything priced in? I don't think we're ever at a point where everything is priced in, but I think you hit the nail on the head there with, if the news is less bad, people are looking for good news. It doesn't always come. I think in previous bounces, there wasn't
a lot of good news in March 2009 or March 2020.
Yes.
But it almost got to a point where it couldn't get worse.
It's all about the turn.
Yeah.
So the data will look bad, but it's just about it getting a little less bad. Things I'll be watching. European policy response to energy prices going up. The US labour market. Any evidence of a bit of cooling there takes a bit of pressure off the Fed. These examples of small turns that can actually be quite meaningful to market direction, given where valuations have got to. The market's priced in the Fed raising rates now. It has priced in a significant slowdown. It hasn't priced in a significant hard landing yet.
Yeah.
But the point is the first two have been priced now.
And is that why, I think it was last month, the US inflation data came out as 8.2% rather than the 8.5% it was the previous month. And you saw rallies all around because it wasn't quite as bad as 8%, and doing cartwheels at 8.2%, which is quite somewhere to be. But
that we felt was a bit premature because people then started talking about a Fed pivot. Which was that's the point.
Which they put right very quickly.
Too early for that. But for example, the payroll report we had on Friday was interesting in the States because we saw a little uptick in the participation rate. That's important because that loosens the labour market a little bit.
Yeah.
So that's the kind of stuff we're watching.
Yeah.
The detail of the US. For the US inflation picture, watch the labour market because if that cools down, the Fed can relax a bit.
So the Jackson Hole speech last week wasn't a surprise to you?
No, because to be fair to the Fed, I think they've said it a few times.
Yes, nobody's listening.
They started December last year. They kept saying, no, we really mean it. You know, it's rare I've seen the market so reluctant to listen to the Fed. You know, Colin Powell, I think, has said it 20 million times. Like, no, I'm really focused on inflation. Yeah, but you don't mean it. No, I mean it.
Yeah.
And actually, in the Bank of England, they're willing to take some economic pain right now.
Yes. Yeah, and I think they've made that clear too. While we're on inflation, I think we had a lot of questions on inflation and what it might mean to individuals, et cetera, et cetera. I think we have to attack this as a theme rather than individual questions. But in terms of the persistency of it, and I think that's quite an interesting word in that we've all got used to, over the last, let's say, 10 years, very low inflation. I think if you go further back, higher inflation was a thing. How persistent would you expect this to be? It feels like zero inflation is a long way away.
I think we're in a new regime.
Yeah.
So basically, the last 20 years were interesting because actually, no matter almost what the output gap was, you know, how much slack there was in the economy, inflation was about 2% in the States. So that made it relatively easy for central banks. The second you got a whiff of a slowdown, they could back off because it just wasn't an inflation problem. When we track those numbers now, we're starting to see relationships between growth and inflation that are more similar to the 90s. Which again would present a regime shift. We don't even have to imagine the 70s here.
Yeah.
So I do believe that inflation is more persistent. I think what's interesting is that it's coming through various channels. One is the acute channel via the geopolitical crisis in Ukraine. That could lessen, I guess, but, you know. Then on top of that, you have still supply bottlenecks to do with COVID. I mean, you're still getting lockdowns in China. So that's not gone away entirely. You have a labour market. I think we've had the most profound reshuffling of the labour market in generations as a result of the pandemic. You know, change in worker behaviour that would have taken years basically got accelerated into 6 months. And I think that has fundamentally changed what workers expect in terms of conditions, et cetera, et cetera. I think wages will be higher. You know, for a long time, we were talking about the Phillips curve, which is the relationship between the unemployment rate and inflation. That relationship had completely broken down. No matter, even when unemployment was really, really low, wages weren't picking up. That was the truth of the last 10 years. I think now we're getting back to more normal relationships. So I do think it's more persistent. Deglobalization is another trend. I mean, on it goes. So I think we're in a new regime.
Yeah.
But it's one we can cope with, you know, and actually there's some benefit to it because actually the last 10 years or 20 years where you just had endlessly low inflation, rates pinned at zero. Rates pinned at zero is not good news for investors. You know, it reduces the risk premium across all asset classes. It compresses them. It borrows return from the future. A return to a more normal rate cycle is actually ultimately healthy for markets.
Yeah. And that's a message that we need to get out to investors more often. You mentioned there about 2% a couple of times. Is the 2% target a bit old world now? Because it's still talked about where the Bank of England is concerned.
I think that they will have to allow inflation to run a bit hot. So
do you think they change the target?
I think the key thing is getting it down.
Yeah.
The target, who knows? I think it will vary by region. But I think there are ways in which they can interpret it differently. but I think they're going to have to accept slightly higher levels of inflation. Yes.
Yeah.
Because the consequences for growth would be too extreme.
Indeed. And I'm just going to read this question out as it was asked, because I think it's worded in a very in quite a good way. How do central banks solve supply side inflation with interest rate rises? And how delicate is the balance here between solving the problem or causing wider damage?
Well, the problem is it's a blunt tool. So the answer is with difficulty.
But they seem wedded to it.
Yes, because their alternative is just to let inflation go rampant. And that stalls up bigger problems in the future.
Yeah.
So, as I said, the decisions faced by central banks have really worsened significantly, because ultimately they have a very blunt tool, which is basically causing growth to slow, creating slack in the economy, creating a rise in the unemployment rate. Unfortunately, that's the only way you get inflation down.
Yeah.
But, you know, for a while, we'd forgotten what inflation really felt like. You know, there were even people saying, oh, well, the way you sort of deal with your debt is you inflate it away. You know, it's like, no, for most people, inflation is a real problem. It really eats into your take-home pay. It causes a cost of living crisis. It is a political issue. And so, unfortunately, I think that some pain will have to be taken.
Yeah.
But over the long term, it's actually better if inflation is kept under some control.
And so looking back through inflationary cycles through time, as an investor trying to put together portfolios, how do you look at it as an investor, positioning for longer inflation cycles, but also interest rate rises? How are you looking at that?
There are a number of consequences. I mean, if we start with bonds, you know, for many years we had what I would call a game of whack-a-mole with the central banks. So the second there was, because yields were pinned at zero, and in many cases negative in Europe, negative rates in Europe, meant that the second you had even the spectre of a yield anywhere globally, there was a wall of money that jumped to it. So that's what I'm saying. It's like a whack-a-mole, right? And I think that's now changed, because central banks are no longer pinning down the curves. You're going to see more rate volatility, more divergence between bond markets, also more opportunities. But the kind of yield we need to be getting from fixed income is going to have to be higher to compensate us for that greater volatility. Again, a lot of damage has been done to fixed income already, though, which is interesting. And actually means that fixed income, once again, is starting to offer attractive yields. So that's one consequence of a more inflationary environment, is that basically it's not a one-way bet with the central banks. I think we also need to think about the implications for equities, you know, being careful not to be too extremely growth-oriented. That was very much underpinned by very low discount rates. I think people for a while had given up on value as a strategy. I think you need to have some value exposure in your portfolio as well. I mean, those are two. I could go on and on. This is a long conversation. Commodity-related exposures are interesting, and that's something that we have the ability to include in the portfolio, which, you know, we discussed with your team precisely to give us that leeway a couple of years ago. We started having that conversation. We said there's a world where actually owning commodities could be useful to the strategy. So those are some implications.
Yeah. And in terms of when you're structuring your portfolio, are you looking from a country level or a sector level, stock level? How does that work?
So basically we have, you know, my team, which is the multi-asset team, this is really looking for what we look at called top down. So we're thinking about all the different asset classes in the different regions. So we're looking to be, we're looking at the weight in equities, the weight in bonds, should we own commodities? We do think a little bit about currency as well, really managing those big picture risks in the portfolio. And then we allocate sleeves to our stock picking experts here at Schroders, and we have some great stock pickers in the portfolio who are then at security level picking the best opportunities based on their style and their region. So it's a combination of both. It's really, I mean, we're really trying to deliver the best of Schroders through this strategy.
Yes. So, not to get too deep into sectors, but we had a couple of questions around, which was really around whether the technology domination, I think we've got used to a decade where a few stocks would drive the market forward globally, not just even in just the US. Is that technology domination over in terms of driving the market up or down? Because it feels like the market cap of these companies is still pretty large. How do you deal with that as a problem as well?
What was interesting was it's not just the technology sector, it was the narrowness of the market. As you say, it was about 5-6 stocks dominating global indices. And that, to some extent, was a function of the fact that rates were pinned at zero. Because if the discount rate is suppressed, that kind of growth in the future, in some sense, has an endless value, right? Because, so the fact we're moving to a more normal discount rate, I think, will challenge the valuations of some technology companies. However, I don't think you can sort of give up on technology. I mean, one of the challenges faced by worker shortages, and I don't think it's a temporary phenomenon, I think that things are shifting. Well, with deglobalization, people bringing production back home, part of the answer is automation, for example. That's a disruptive trend that we still think is important to think about. We're not going back to candles. I mean, ultimately, the world is moving forward. Yes. Technological innovation is something we want to be exposed to in the portfolio.
Yeah, that's good. That's good. And in terms of, you mentioned China there a couple of answers ago, and various other things going around. We had a couple of questions around semiconductors and China, Taiwan. I don't like going in the way of politics, but it's difficult not to with that particular question. How are you viewing that evolving situation there? Is it another thing just to take into account in
It's
geopolitics?
another thing to take into account. I mean, I think we need to step back. What is the bigger picture trend? Is that, in a world, we are seeing greater competition for resources. In a world which is moving down the path of technology, there's certain critical, and also decarbonisation, there's competition for resources globally. And, we are deglobalising to some extent. So that creates more friction. Whenever the pie is shrinking or when there's competition for scarce resources, you always have more political problems. Yeah. So that's one of the challenges we face. And it sort of manifests itself in various ways. Equally, when the economic pie is not growing rapidly, you also see increased populism around the world. We've seen it in recent years with Trump, various things that have happened all over Europe as well. So it's interesting, when you step back, the high levels of geopolitical tension, high levels of populism all have their roots in the fundamental problem is that the economic pie isn't growing fast enough. In fact, it's shrinking to some extent. And because of major structural shifts, there's competition for scarce resources. So that's a regime issue we have. Yeah. Now, how do we deal with China and Taiwan? I mean, that is obviously a major challenge. I don't think you can sort of, the risks are so great. It's I think we're a bit like the Cold War. In some sense, the risk of escalation between Russia and the US was so great that in the end, no, they didn't go there, right? They had sort of hot wars, but ultimately that there was actually quite a lot of stability in that system. It was a very fragile equilibrium. I think that's where we are now. I don't think you can position the portfolio on the assumption that something's going to happen in Taiwan. No. But what we have in our portfolio is the ability to adjust should we move into that dark place. Yes, yes.
And it won't stop the media talking about it.
Yes.
It's, again, I talk about 24-hour news, and this kind of geopolitics, in my view, has always happened. Yes. It's always been there. You may not just have been hearing about it all the time.
Yes.
And social media just spreads things within seconds and things like that. So I think there is an element of that, which is just a challenge for investors, but isn't going to go away. That noise is still going to be there, regardless. In terms of noise, I'm conscious of how much we're talking about negative things because I want to get those out of the way. And there's a lot of questions about this kind of thing. But the word recession is bandied about constantly. It's probably the next thing that people will be talking about or hearing about. What does it mean for you when looking at a longer-term strategy with all the short-term economic data that is being talked about constantly?
So we think of, our whole strategy is predicated on evolving the portfolio through the economic cycle. So for us to move into recession is not noise, and is actually our central scenario for 2023.
Okay.
So we're there. And when we do our analysis through various cycles, what does a recession mean? There are a number of consequences. We've been underweight bonds all year, but at some point, they're going to start looking attractive because actually that's a great place to hide as you go into recession. And the good news is the yields have repriced there. So, I think that could be an interesting allocation in months to come. Yeah. So bonds are going, if I was using a traffic light, from red, they're currently amber, possibly green in the next few months. So that's an immediate opportunity. With regard to equities, the challenge we have right now is that corporate earnings expectations haven't adjusted enough to really price in that recession risk. So we're not in an environment where you can just shut your eyes and buy no matter what the growth outcome is. But as I said, valuations have cheapened up. And again, what our work shows is that once you are in recession is when you get the best opportunities to buy equities. So we're still underweight equities, but I think as we move into recession and we're trying to work out, the depth and the timing of it, but, we could start to see some major opportunities as we move into 2023 in equities. Yeah. Because actually, our analysis shows the worst phase of the cycle is the phase we're currently in, which is the slowdown phase. This is where growth is still positive, but expectations are being ratcheted lower and rates are going up. Okay. By the time you hit recession, typically you've got valuation on your side, and actually you start to talk about central banks easing off. Although economically the news is bad, the discount rate's starting to work in your favour.
Yes.
So actually, compared to the beginning of the year, still underweight equities now. But actually, I'm looking ahead now to the opportunities. So recession, highly likely for 2023. But from a market standpoint, that is an opportunity.
I talk quite a lot with investors about markets being a leading indicator and economic data being backward-looking.
Markets in the process of pricing it in right now.
Yes, yeah. And if you're waiting for the good news, then you're probably going to be left behind.
Too late.
Yeah, that's historically, that tends to happen. You mentioned bonds, and I'd like to dig a bit deeper into that. The question was worded as, with global bonds under a huge amount of pressure, do we see potential opportunities from bonds? I'd like to dig a bit further into that. What are the potential yields on offer in that area compared to maybe where they were 6-9 months ago?
Well, I mean, Euro credit, for example, European investment grade debt was trading, around 2%. I mean, now we're talking about 5-6% yields, you know. Depending on what you buy, of course, there's huge variation depending on what you choose to buy. But, I mean, there's been a very dramatic repricing. Now, we don't believe they should go back to the lows because we're in a new regime. But the fact that you can start to buy fixed income on yield again is a huge difference to where we've been in the last decade, where you basically bought bonds for their negative correlation benefits. They had no yield to speak of. Now you own them for different reasons. I think they might be more positively correlated with equities in an inflationary environment. But the fact they have the yield there is an important cushion in the portfolio. Yeah. So we do think they're attractive. You know, again, we haven't really moved in this direction yet, but it's on our radar screen. Emerging market debt, investment grade debt. Too early for high yield debt because high yield debt's very economically sensitive. But that's I think the next opportunity in the next few months.
Yeah. So we might be able to enter a period where we can talk about bonds as exciting for once. Yeah?
Yes, I think they've been pretty exciting this year, just in a negative way.
Yeah, exciting would be one word for it, yeah.
Yeah.
I'm conscious of talking about things like bonds because not everyone is investing for growth. A lot of people invest for income, and bonds are a key part of that over time. Where dividends are concerned, do you think we're going to enter a period where dividends become an important source of total return again, or are we still in that sort of shake-up of who's going to come back with a yield and who's not?
I mean, we tend to think about it in terms of total return. I actually think the biggest opportunity in equities over 12 months now is a re-rating, which is not about dividends. It's about eventually the market looking through to central banks easing off. So an expansion of the PE multiple. So I think that's the great opportunity over the next 12 months. Yeah. Dividends was the right way to be this year as markets fell. Yeah. But actually, as I said, I think we've seen quite a lot of an adjustment already.
Yeah, yeah. Dividends seem to be a bit of a UK obsession as well.
Yes.
Globally, when we talk to fund managers around the world, dividends don't really play a huge part in portfolios. Within your portfolio, do dividends play a big part or not?
You think about it, total return. So the dividend's helpful. The UK market's known for its higher dividend, which is helpful to returns. Yeah. But yeah, not a big focus for us.
Okay. This one was worded again quite interestingly. Away from the negative things you were inevitably going to talk about, are there areas of potential opportunity going forward? It's quite a vague question, but it's...
Yeah, but there are. I mean, so I've sort of talked about the opportunities as we enter recession. I think that even this quarter, though, the next few months, so I guess earlier this year, I really couldn't see any positive view on equities, because I thought on the one hand, you got rates going up, and on the other hand, the only thing that will stop central banks is if we plunge into some endless recession. Right. With pricing having moved as much as it has, as I said, there are opportunities as we move into the recessionary environment actually to pick up opportunities in equities. That's my central scenario, is that we're really buying equities as we move into 2023. Could it happen sooner? The kind of things that could provide some relief would be, for example, the European authorities stepping in on energy prices, evidence of cooling of the labour market in the States. That would imply that the US 10-year bond is now peaking, which means it pulls forward the re-rating of equities. In an inflationary environment, any sign of a more persistent peaking of inflation can trigger quite a significant bounce. So as I said, traffic lights, it was properly red early this year, but it's shifting now. You know, the prices have reacted.
You've mentioned European action a few times. Is that something you think will happen? Is that a probability here? Without making predictions?
Hard to predict, but I think that, well, we're already seeing it even in this country, you know, talk of intervention by the government. I think that, especially with the fact that a lot of the pain has been caused by the situation in Ukraine, I think there is the political will to support consumers.
So you think once one goes, it will lead, much like QE did?
Yes.
Once the Fed went, everyone, that was the template.
Well, I just think there's a couple of things. Again, this is, I mean, who knows, but I think a couple of things have changed. I think the pandemic got us used to a level of government intervention that was unthinkable before.
Yes.
That's number one. I think number two, you know, the cost of living crisis in Europe is pretty bleak, and the economic pain is palpable. And given that it's been caused by a war, that ultimately European authorities, you know, don't want, you know, that they're supporting Ukraine. I feel like this is the political environment where governments are more willing to step in.
Okay, interesting. Closer to home, sterling has fallen quite substantially. Again, we're seeing headlines galore about these levels. Is that something you take into account day to day, or is it?
Yes, we do.
So how does that work?
I think it's fashionable to say currency doesn't matter. It does matter. So we have had a negative view on sterling. I think now what it does is ultimately, though, make UK assets quite attractive globally. So that's an interesting trend we need to keep an eye on. I mean, sterling is starting to look quite cheap at this point. Of course, it's part of a broader trend, though. So it's not just sterling that's fallen. Sterling's been the weakest. But actually, of course, the other side of the equation has been the really dominant trend, which is a stronger dollar.
Yes.
And right now, it's hard to see how the dollar could really weaken, because ultimately the Fed is raising rates and they're going ahead of other central banks. Yeah. So I think that we're still in a strong dollar environment. I think the extent to which sterling has fallen relative to other currencies like I think it is starting to look quite cheap, you know. But our central scenario is still for dollar strength.
And does that benefit the UK economy?
It does.
And
it's a shock absorber. Yeah. And that's why, again, I mean, currency is a critical part of our economic fortunes and the performance of the FTSE, by the way. So the FTSE, because of the high percentage of overseas earners, it helps, and you see it. You saw it even yesterday. I mean, so the ability, the fact that sterling cheapens up is an important shock absorber for this economy. Yeah,
negative headlines, and then as we saw after the referendum day, you know, currency goes down, negatively correlated to the FTSE. You mentioned the strong US dollar there. I mean, but does that hinder obviously it doesn't hinder the US in the same way it was hinder the UK. How strong can the dollar be before it becomes an issue for the US?
Well, I think I mean, actually the US, and this is why in some sense the currency markets are taking the adjustment. So, you know, Europe and the UK have a massive challenge because of high energy prices. It's helpful to them to have cheaper currencies. The US economy, you know, is a more closed economy. It's actually very strong. If anything, it's overheating. So the strength of the dollar is quite helpful to the US economy because it actually helps the Federal Reserve to tighten conditions. Yeah. So in some sense, right now, currencies are being quite helpful in the way they're moving.
Is there going to be a point where global-focused US companies start being uncompetitive compared to European ones? Or, well, I guess, is there a European opportunity there relative to?
I think there's a European opportunity in the sense that, again, our exporters have got a lot cheaper now. So ultimately, that cheaper currency is helpful to the European region. Yeah.
And how does that strong dollar affect Asia and emerging markets?
You see, I mean, that's the challenge, is that the risk you have with the dollar is not so much the US domestic economy. It's more that the more the dollar strengthens, the more it can create pressure in the global economy. And that's the challenge. So it's not so much for the US economy, it's just that tightening dollar liquidity is typically not helpful for risk assets globally if it goes too far.
So it's not something that the Federal Reserve will.
Well, funny enough, I think to some extent the Fed right now is focused on solving a domestic problem. Yes. I think that probably US rate policy will hurt the rest of the world before it really hurts the US.
Yeah. Okay. So we've received multiple questions on ethical and environmental considerations and how you incorporate that into your process. Can you talk about how you incorporate that on a daily basis? Because I know that St James's Place and Schroders have worked on that over time. So yeah, what's your sort of ESG considerations on an ongoing basis?
Well, I mean, it's something that we incorporate into all of our investment processes here at Schroders. So we have our own proprietary analysis. We have a range of tools we've developed, but probably the main one is called SustainX, and it's a way of basically quantifying the impact to society of a company's activities, and gives you a risk to earnings, of shifts in regulation, and it gives you an idea of the risks you're running on that front. So it's helpful to have that common language because it means that investors can really share ideas across the platform on how to think about these risks in the context of the portfolio. So, we invested early in this. We were targeting, from memory, I think it was by the end of 2019, to have all our desks incorporating these risks into their assessments, and that was achieved. Very much part of our daily language.
Yeah. And in terms of where you're investing, how you mentioned China, for example. Yeah. People do marry up in their questions ESG and China investment. How do you view that? How do you assess that? Is it an evolving process?
Yeah, I mean, China is probably one of the most controversial, but I think the first thing we have to do when assessing any investment, being a company or countries, we have to look across the piece. So, if we look at China, for example, its efforts on the environmental side have been a positive. So when we calculate SustainX scores, not just for companies, but for countries. So when we look at China, clearly it doesn't score well in human rights. But, for example, it's got an improving score on environmental. And so, we have to balance all of these things at the same time. Ultimately, of course, we follow guidelines of the governments. Obviously, Russia was an extreme example where sanctions were imposed, and we followed that. And I mean, let's hope things don't get that bad in China. But that is one of the challenges we run politically. Yeah. But I think the important thing is to assess things from a multifaceted perspective, and we do this with the companies as well.
Okay. So I try not to go to politics in this, and we've discussed that before. But there have been questions. Obviously, we've been through quite a long leadership campaign, which culminated yesterday. My view with long-term investment strategies of political cycles will come and go. They're just there. Is there anything different that you think you need to position for from the transition from old Prime Minister to new one in the UK?
No.
Short
it's
answer.
A short answer.
Excellent.
I mean, I think in the long term, let's see what the consequence. If they prove to be very profligate, are there consequences for the cost of debt in this country? But we're not there yet. Yeah. I wouldn't worry. We've got other things to worry about right now.
You don't think there'll be revolution here and sort of a wholesale changing of policies or anything like that?
No.
No. Okay. That's the UK. We also get questions on the US, which I do think we're on the cusp of hearing about more and more because the presidential race is so long that the next one is likely to be talked about more. Again, is that something that you can look at, position for 2 years down the line, or because so much can change?
So let's go back to something we discussed at the beginning of this conversation. So let's think about, is the political division in the US extreme? Absolutely. There's no question of that. So are there some political risks in the US? Yes, there are. And I think that the political system is moving in directions that we simply could not have predicted even a year ago. So things are quite extreme in the US. Now, in terms of markets, though, do we think it's going to influence the direction of central bank policy in the next 1 to 3 years? No, we don't.
Okay.
So we don't think that they're raising rates anyway, irrespective of what's going on politically. And then the second question is what happens to growth? And again, it's not got to a point yet where it's impacting the US domestic economy. So I think that's, for now, not an issue. But we need to think about the sort of regime over the medium term. And I think the final thing maybe politically to say is that years of quantitative easing really benefited profits as a percentage of GDP. And the pendulum was already ripe for swinging more towards wages as a percentage of GDP or labour as a percentage of GDP. They weren't getting enough of the pie. And that's why you saw the rise of populism all over the place. You know, the average person wasn't doing well enough out of the system. So I do, as I said, expect wages to be stronger in this environment. And it's really a consequence of policies that actually now, that's actually where both sides of the US political spectrum agree.
Okay.
Right, so you also have to look
at somewhere then.
Yeah, so almost irrespective of anything, I think that it contributes to this idea that there's an agenda about improving the lot of the average person, which means higher wages. And I actually think that's ultimately, it's a more sustainable outcome, right? What's the good point of producing all these goods that people can't afford to buy?
Yeah, something's got to give.
Something's got to give.
Yeah. This may be a short answer as well. We got a couple of questions on cryptocurrency and everything that's happened there in the last 6 months. Yeah, the question's as vague as that. What do you think?
So we don't include them in the portfolio, but we do research them.
Okay.
And obviously they've corrected substantially. I wouldn't be putting them into portfolios just yet. I think the challenge I have, you know, as a professional investor, is that we don't have enough data yet to really understand the correlation of crypto with other asset classes. And so in a portfolio construction context, I think it's too early to be investing in them. However, what is certainly true is and it comes back to the point we were making earlier about technology, you know, yes, we're in a different environment from a discount rate perspective, which maybe curbs the outperformance of technology, but we're still in a world of technological disruption. And the underlying blockchain technology is a real trend. It's something that we're looking at thematically within our equity portfolios. And so while I wouldn't invest in crypto, I also wouldn't disparage the underlying trend in blockchain technology. That is something we are looking at, stock pickers.
Interesting. Final question, again, quite a vague one. What would you say to an investor who is concerned about investing now for the next 10 years?
I think you have to look at valuations. So again, what's happened this year with the fall in markets is that the long-term return potential of markets has been improved. And the simplest way to look at that is if you look at the yields of government bonds. So if you do a 10-year, the best way to predict the 10-year return of government bonds is to look at the starting yield. It actually works. And so if you look at starting yields today in fixed income compared to where we were a year ago, you know, actually the prospective return has improved. Doesn't mean we're through the volatility yet, but on a 10-year view, there's definitely been an improvement. And just look, and then, you know, typically when we do these long-term return forecasts, we start with the assumption for the 10-year return and then bond return, and then we build equities up from that. Yeah. So that move in fixed income is, I know people think bonds are boring, but from a long-term perspective, it tells you something about the return potential of the market.
Yeah. I wonder whether we're entering a period where people want boring as well.
Yes. I might even buy some bonds.
Look, time's got ahead of us, I'm afraid. Thank you so much for your candid answers and answering everything I've thrown at you today. And thank you to everyone who's sent their questions in ahead of the event as well. Thank you to Rebecca Garrity and her team for setting this up, as well as everyone at Schroders who's been so accommodating behind the scenes as well. Everyone, please stay safe, stay well, and we'll see you again soon. Thank you.